low was when the ISM collapsed, the Fed pivoted, and then growth stocks and crypto, don't forget that was the exact low in Bitcoin.
Before we move forward, I'd just like to remind you that we're giving away $100 to a random subscriber at the end of this month. To take part in it, all you have to do is subscribe to our channel, like this video, and leave a comment in the comments section below. Good luck. Now coming back to Raoul Pal's interview, he talked about what the Feds are up to and how it could affect Bitcoin and other cryptos in the near future. He talked about stocks and bonds, how their movement is affecting cryptos right now, and how Bitcoin's network is becoming more efficient. Basically, he talked about several factors that will continue to affect Bitcoin's price in the coming months. If you want to hear Raoul's comments on the crypto market, watch this video till the end, and don't forget to press the like button. Now, let's look at his interview.
Just to show what I mean again about the fact that the central bank balance sheet drive up asset prices, it's a pretty clear correlation. And I know a lot of people say it's spurious, but my God, it's worked absolutely perfectly. I think of this as actually a decrease in the value of the denominator. If the value of the denominator is, if the denominator is the purchasing power of your dollar, then if you print more dollars, then the purchasing power goes down. That's the supply side of the equation. And the supply side of the equation here, we can see what it does, that the purchasing power of the dollar goes down and assets go up. This is consistent everywhere in the world, everywhere the central bank balance sheet increases, and it works across all asset prices essentially, whether it's gold, whether it's real estate, it affects crypto, it affects stocks. And what's amazing is real estate is so good for this that I've looked at ECB money printing, and then looked at German real estate, same chart, Swedish real estate, Swedish money printing, Canadian real estate, Canadian money printing, US real estate, UK real estate, Australian real estate, they're all the same. So what they're saying is every time the Fed print money, the purchasing power of the dollar goes down, which makes it optically look like the value of these assets are rising. Most of them are actually not rising in central bank balance sheet terms. So it makes it harder and harder for those poor people whose wages haven't gone up to stay up. So they keep borrowing money to do it. And it's a mess. And this is what's creating the 1% versus the 99. Obviously, GDP is the net outcome of all of the things I've talked about. Now, we've got this, obviously, the weird shenanigans in the price action due to the pandemic. But GDP really, really mirrors the labour force participation rate. And it tells us that GDP growth over time is going to keep falling and falling and falling. So we're in a slow growth world driven by demographics and debt. The central banks need to keep propping it all up, and that keeps going into the future, and that's baked in the cake. So that's the secular structural view. But now let's talk about demand and where we are in the business cycle. The business cycle is looking like it is about to roll over really, really hard. And I talked about the massive monetary tightening we've had. This is the biggest monetary tightening in all recorded history in the shortest period of time. We've got rising commodity costs, rising interest rates, and a strong dollar. Those three things together are extraordinary. So here is a combination of those three against the ISM, and it's already pricing in a recession. ISM below 47 is a recession. It's saying the 9-month forward ISM is going to be 37, and it's still going. So it kind of feels that we're going to go into a very sharp, urgent recession, and that's what the markets are picking up. That's what crypto's picking up. That's what equities have been picking up. Equities are currently pricing the ISM on a year-on-year basis at around 49. So they've got further to go to price in some of this, but the comparisons get easier because the market went up a lot this time last year going forwards. So I'm looking closer towards the low, and I'll come into that in a bit. Now, that situation is very similar to the situation I've seen many times in the past, and I'll come on to that in a bit. But you can see CPI, if I look at commodity prices, they're already telling us CPI is about to come lower. It seems to be slightly lagged, but it's coming. If I therefore put it by 6 months, it's telling us that CPI is about to roll over and roll over hard. I think CPI should be at around 4% and not about the 8% it is today. Also, the ISM and the central bank balance sheets. As the ISM starts falling, the central bank balance sheets should stop contracting, which is what they're trying to do now, and eventually start expanding. And they'll start expanding really once we see the ISM hit 50. That's when the Fed tends to panic. That's when they panicked in 2018. That's when they panicked in 2001. That's when they panicked in 2008. That's when they panicked in 1984. That's when they panicked in 1974. And the thing that's mispriced here is bonds. If we know that the forward-looking indicators for ISM are suggesting it comes somewhere between, let's say, 30 and 40, i.e. a shocking change and a severe recession, then the rate of change of bond yields is still looking at inflation, which is rolling over. And it's rare that bonds get this wrong, but it got it wrong it got it wrong severely in 2000 because inflation was running really high then. The Fed were cutting all the way into that inflation in the end because economic growth had rolled over. And I think we'll see something similar, and bond yields look to be one of the best trades in the world right now to be long bonds, particularly in this liquidation phase when everything else you own turns to shit, including some of the commodity trends. Now, 2018, I don't know if this chart's going to hold out properly, but it's similar. Is 2018, the NASDAQ looked very similar to the NASDAQ now. It plunged into some final low, a capitulation low. That capitulation low was when the ISM collapsed, the Fed pivoted, and then growth stocks and crypto. Don't forget, that was the exact low in Bitcoin. And I think we're going to set up for something similar now. The question is how long will this recession be? And that's very difficult to know. I'm using actually 1974 as my basis. 1974, we saw a very similar setup with very high oil prices due to supply restraints. That was the Arab oil embargo. We saw inflation skyrocketing. We saw rates skyrocketing, the dollar going up, and then suddenly the whole lot unwound as the Fed over-tightened and the economy collapsed. And as I said, it went from 56 on the ISM to negative 30, the fastest recession we'd ever reached one of the deepest recessions since 1929, 1930, 1931. And it was over as fast as it started. And stocks went up rapidly from there. And eventually we had a second inflation shock. I don't know what plays out going forwards, but I don't think it's the 1970s secondary inflation shock. I understand commodity prices might remain high, but I think the rate of change will slow down, that inflation goes back down to the level suggested by demographics, which will be somewhere around the, between 1% and 3% range. And I think therefore bond yields do the same. There is a chance that bond yields go back down to zero. Now, 1984 was the other setup that was very similar. We had an extremely strong dollar. We had high interest rates. We had an equity market that was falling. And then the economy fell off a cliff. CPI was high. The economy fell off a cliff. The oil price collapsed, and the Fed cut into a recession period. What looked like it was going to be a recession period. The Fed managed to forestall it, but that eventually led to the Plaza Accord in 1985, which stopped the dollar destroying growth going forwards. And I think we'll get potentially another big dollar rally next year, and that I think that all of the central banks are going to have to do something about, or it's going to cause a much longer recession than the 1974 example. 2001 was the other example, 2001, where we saw similar kinds of setups with high inflation, the Fed cutting into that inflation, the equity market collapsing. That went on much longer, and it went on much longer because of the unwind of the equity market. And I think that the debt buildup was still high, but not as high as it is now. So the Fed, I don't know. 2001 is an example of what I'm scared of, that this episode now goes on for 18 months, 2 years. So I would mark that as, okay, if we get a capitulation low now, then maybe there's a big rally and then another collapse to come because the economy remains in recession. 2008 was a slow burner, but then the Fed discovered the balance sheet. And again, around that time, we had high inflation, as it always is at the peak of the cycle, interest rates rising, financial conditions rising, everything collapses. Very similar to now. That uncovered a financial crisis. I don't see the evidence of that. People are waiting for what is the shoe to drop for this cycle. I think the shoe is the economy, like 1974. And it's not a financial event, more an economic event, and probably the US consumer event. Now, in 2008, the Fed discovered the new trick, which was the balance sheet. Now, if you understand the balance sheet as you expand it, automatically makes the S&P and other risk assets reprice higher because the denominator's fallen. That stopped the rot because the collateral in the system goes up in price and everything kind of resets. And every time the Fed have used the balance sheet since, it's had exactly the same impact, which is an immediate turn in asset prices. Had an immediate turn once it was used in 2009. It had immediate turn when it was used in the pandemic, and it had immediate turn when it stopped. When the market started to sniff it out in 2018. I don't see any reason why the Fed won't do it again. So I'm anticipating a short, very sharp recession and a return to use of the Fed balance sheet, direct transfer payments to give money directly to poorer people, and the Fed having to support some parts of the markets again. But let's see how it plays out. The main point being is we've got the worst ahead of us. It's not fully priced in by markets. It's going to be faster than people expect. It's going to be more severe than people expect. And then we can looking forwards. Look, we've all got the wallet of shame of a whole bunch of tokens that have gone down 80% or so. And those were, I did that on purpose. I chose an equally weighted basket plus a few other bets, and I knew that it was high risk. So, it's not something that concerns me. And within that would have been some of the layer ones, some metaverse, some social tokens, all that kind of stuff. And that was really to see the space, see what's getting adoption, just keep in it and keep learning and just see how that pans out. And then the bulk, 85% of it is all in ETH. And then there's a small amount in Bitcoin. Feels that ETH wants to underperform Bitcoin for a bit now as we hit the final liquidation phase. But that ETH bet was a very good bet versus Bitcoin. I think that continues because of network growth is faster. And I think what I'm looking to do is I think the next phase will be, okay, I think ETH will do well the next cycle, but like Bitcoin did, not as well as it did the previous cycle, because that's how network adoption works. And there'll be one or two other layer ones that will do very well. My kind of hunches are Solana and maybe AVAX, don't know. AVAX a bit complicated for me, so I'm not really sure, but interesting. And then there's going to be trying to capture, okay, what is this next phase going forwards of NFTs and social tokens, and how do you even play that? Because it doesn't really exist to invest in right now. We don't really know. We don't even know what chains half of this stuff is going to end up on. Where the POAPs exist in the end. My guess is Solana's going to get more than we think of this stuff. As more Solana wallets and integrations like Ledger, you can have these Solana and stuff like that in, it becomes something more interesting. But maybe it's not. Solana's got its own problems. It keeps seizing up. So we'll wait and see. I've got no strong view yet, but there'll always be something. And then there'll be the fat tail, which is the thing you didn't see that goes up, 1,000x. And who knows what that is. That just takes time to uncover and an understanding of the space.